All right, going to get started. So thank you everyone for joining us today. This is our third webinar with AgriLogic. Today we're going over let me see real quick, sorry. Actual production history programs, or the annual and perennial actual production history programs. And I'm joined here with Kim Harris, Tom Bland, and Brandon McDonald. Again, it's being recorded. It will be uploaded to our YouTube channel. So if you have any questions, feel free to put them in the chat or Q&A. And yeah, we'll go ahead and get started. Kim, take it away.
All right. Well, thank you very much, Diego. Let me get everything here. There, if I can see my screen. Well, welcome everybody to the actual production history program presentation. We appreciate you taking the time out of your day to join us for this program. The actual production history program is actually the oldest crop insurance policy under the federal government system. We are AgriLogic Consulting. We're an economic and insurance consulting firm. We work with the federal government to develop risk management and also with the private sector. For this program, we're working with the Farmer Veteran Coalition and also with the USDA Risk Management Agency to deliver training programs and training webinars to new farmers, particularly in this case that are veterans. And so the program that we're going to provide today is on the actual production history program. And the presentation is going to summarize the benefits that are available to veterans and beginning farmer and ranchers under the federal crop insurance program. And also we're going to discuss the very components and characteristics of the APH program, which I just mentioned, and give some examples of how the APH program works. So first I wanted to talk just a few minutes about VFR, or Veteran Farmer and Rancher. Everything crop insurance is just like military in that we live and die by the acronym. So when we're talking about VFR, we're talking about the Veteran Farmer and Rancher. To qualify for this, you have to meet one of the following conditions in that you have never operated. Oh, let me go back a slide. I think we missed just a moment there. And to qualify for this, you have to be an individual who served on active duty in one of the following components. And I've got them all listed there. I don't think there's any that are missing there. And were discharged under conditions other than dishonorable. You have to meet one of the following conditions in that you have never owned or never operated a farm or ranch, or you have operated a farm or ranch for less than 5 or not more than 5 years, so 5 years less, or you became a veteran in the most recent 5 years. And that's even if you've previously operated a farm or ranch for more than 5 years. If your entity or your farming entity is a business, the business may qualify as a veteran farmer rancher for the benefits of that, as long as what we call the substantial beneficial interest holders in the entity all qualify as a VFR. And an SBI is somebody that has at least a 10% interest in the entity. So like if we're talking like there's 3 or 4 people in a LLC or something like that, all of the people that have at least a 10% share in that LLC have to qualify as VFR. If it's a situation where it's a married couple, a veteran and their non-veteran spouse are considered a VFR. Both spouses don't have to be veterans. Excuse me. The benefits for qualifying for a VFR are pretty substantial, in that every policy has an administrative fee. There's 2 types of policies: catastrophic, which is the bare minimum coverage, and then buy up, where you can buy higher coverage levels. So the admin fee is not charged if you qualify as a veteran and veteran farmer or rancher. In addition to that, every policy has a subsidy in which the government is paying a portion of the premium. If you qualify as a VFR, then you receive an additional 10% premium on top of the subsidy that's already available. And then we'll talk about this a little bit later in the webinar. There's certain times where you can use someone else's production history for a piece of land, and it just kind of loosens up those qualifications. So we'll talk about that a little bit further down the road. And then the final benefit is there is an option under the program that's called yield adjustment. And let's say in a year you had a really low yield because of a drought. For under the normal policy, you get a 60% of the transitional yield, the county T yield, plugged in place of your really low yield. But if you qualify for VFR, you're going to get an 80% plug-in. So, and we'll talk about the YA program down the road, and I'll kind of show you how that makes a huge difference. So those are the veteran farmer rancher benefits for every crop insurance policy, but particularly the APH policy. Also, there's something called the beginning farmer and rancher. So you have the veteran farmer and rancher, and then the beginning farmer and rancher, and the benefits that they receive are the same. So whether you qualify as a beginning farmer rancher or whether you qualify as a veteran farmer rancher, you receive the same benefits. To qualify as a beginning farmer rancher, you have to have operated a farm or ranch for no more than 5 years. There's a program out there called the Whole Farm Revenue Protection Plan. Under that program, it's 10 years, and we will have a webinar on the Whole Farm Revenue Protection. Actually, we already did the Whole Farm Revenue Protection, so you can go out and look for that one. Crop years are excluded. So when we're talking about do you qualify, the years that you farmed that you were under 18 years of age don't count against your 5 years. So let's say you had an FFA project, and so theoretically you raised a crop and sold it, or you raised some livestock and sold them. That year does not count if you weren't 18 years of age. Also, if you're enrolled in post-secondary studies, think college, for up to 5 crop years, and then the years that you are on active duty in the U.S. military, and let's say that you are also involved in farming during those years do not count against you. You have to be an individual. Again, businesses to qualify, same as with the veteran farmer and rancher. All beneficial holders have to qualify as a BFR, with the exception of if it's a spousal policy. A limited resource farmer and rancher is not beginning or veteran farmer, but it's a separate program. It's available for farmers who have a direct or indirect gross farm sales that's not greater than an index value, and the total household income has to be at or below the national poverty level for a family of 4, and that or less than 50% of the county median household income in each of your 2 previous years. So as it in the title of the program, it's a limited resource farmer and rancher. And the benefits under the limited resource farmer and rancher, there are some financial and technical assistance programs that are available. And also there is no, anybody who qualifies under this program does not pay any, I'm sorry, I lost the word there, and does not pay any administrative fees for any of the policies, similar to veteran and beginning farmer rancher. So there is a tool out there actually to see if you qualify, and we've given you the link there to find out if you qualify for a limited resource farmer and rancher. And this qualifies no matter what plan of insurance that you're working under. So if you're working under whole farm protection or any other of the plans that the USDA RMA offers, the limited resource farmer and rancher is available, as are the veteran and beginning farmer and rancher programs. So those are some of the benefits that are available specifically to you guys as veterans. Okay, we're going to move on into the APH plan of insurance. As I mentioned, it is the oldest and kind of beginning of how crop insurance began. It's also the second largest program nationwide in terms of liability. So in 2023, this map kind of demonstrates where the hotspots are for the APH program. You can see in the state of California, you have a lot of liability, APH liability, and think grapes, all of the fruit trees, almonds, pistachios, all the fruit trees and nut trees. And then you got the Pacific Northwest, and you've got apples and peaches. So all those tree plants, all of those tree crops and vine crops, they all fall under the APH plan. When you kind of look up in Montana, North Dakota, South Dakota, you're getting into some of the bean crops, the hemp crops. Well, that's not a huge one, but we'll kind of go through each of the programs and kind of where they're located. There are over 52,000 policies, APH policies, that earned premium in 2023. So if you have 0 acres, you may have a policy in place, but there's no premium earned. When you plant the first acre, then you have premium due. There are over 10 million acres insured in the 2023 crop year just under the APH program alone. with a liability of a little bit over 19.1 billion with a B dollars. So it's a huge program, the federal crop insurance program. So the top number of policies, and as far as policies earning premium, sugar beets tops out the list. So there are more sugar beet policies earning premium than any other crop under the APH. And then grapes would be a close second. So you can kind of see the different crops, the top crops that have a lot of policies, which would kind of indicate smaller acreages, not huge acreages. In terms of top insured acres, so this is the number of acres that are insured under the policy. Forage production tops the list, followed closely by sugar beets, about 500,000 less than forage production, and then almonds, sugar cane. So you can kind of see some of the same policies, crops are on both lists here, but in a different order. When we get into liability, then it kind of changes because we have higher liability crops, which means they're worth more, their value is more. So almonds is the top liability APH program, followed by grapes and apples, which is not a surprise based on what the value of the crop itself. And then when we're talking about premium, because premium is based off of the liability, but the rates are different based on the risk. So top programs in premium are apples, followed by grapes, potatoes, and almonds. It's kind of a little interesting facts on how that works. The crops that are covered, or commodities that are covered under the APH program, take up 3 slides. So I'm going to kind of just zip through these. So you can see there's a lot of crops that are covered under the APH program. And so, any of these might be in your area. It might be something that you would be able to cover your commodity. If it's not available yet, there's a good possibility it will be here down the road, because there is a big focus on specialty crops and making sure that there's coverage available. The major crops, corn, soybeans, wheat, cotton, they've had coverage for a long time, but there's been a big initiative towards getting into specialty crops and some of the smaller commodities that haven't had insurance up until this time. So for reporting under the policy, you'll have several different documents that you'll have to complete as part of the policy. And so this slide is just going to show you the document that you'll fill out and what it does. So the first one is your application, which gets your insurance going. So you can fill out an application if you're thinking about insuring a commodity, but let's say you don't get that commodity planted, it doesn't cost you anything, but the minute you plant that first acre, then you will start earning premium. So the application gives the insured information and what coverages you elect for your commodities, what counties you're going to be insuring in, what commodities you're going to insure, and what coverage levels. So that gets the policy in place and gets it started. For perennial crops, say your tree crops and your vine crops that are perennials, you'll fill out a producer's acceptance worksheet, which basically is certifying the condition of your grove or your orchard. And as I mentioned, it's just for perennials only. You don't fill out what they call a PAW unless you're working on perennials. Your production report is what establishes your approved yield. So everything under the APH policy revolves around the approved yield. The approved yield is saying, here is my historical average yield. And then you're insuring a percentage of that. And that's established using your production report. So for the first year, you give your history, and then each year you'll file another production report that reports what you grew this year, and it gets added on to your historical. And then finally, the acreage report, that is where you say, okay, this year I got this many acres planted of this crop, and here's my share, and it establishes how much premium you own, what your guarantee is, and what your liability is. So that is the final step as far as the forms that you fill out. And that's when you'll know, here's what I owe finally, because when you establish your policy, you do not have your crop planted yet unless you're doing a perennial. So the acreage report is the final document that you complete that shows how many acres you planted and what your interest in them is. So the acreage production history program I'm sorry, actual production history program, it covers yield losses. So it only covers a loss in yield, doesn't look at, how much the price went down through the year, but just looks at losses in yield due to naturally occurring perils. And again, decline in price is not covered. It's based on your actual average, what you've historically averaged over the last 4 to 10 years. You take that average, which is called your approved yield, and you insure a percentage of that, anywhere between 50 and 75%. There are some crops in which you can insure up to 85%, but the majority of them are 50 to 75% coverage levels. And then if you do not grow, or if your acreage doesn't yield that percentage or that amount of yield, then you will get paid for the lost bushels, pounds, whatever it would happen to be, at an established price that RMA has posted at the very beginning of the season. So we'll get into some examples here and show you how that works. Your approved yield, as I mentioned, is what everything revolves around. It is the simple average of 4 to 10 years worth of yields. So you can use your actual yields. Let's say you've grown grapes for 5 years. So you will report how many acres you have and what production, how many pounds that you've gotten off the last 5 years, and that will determine your actual yields. You also can use another person's yield. So for example, if you are in a crop share arrangement with another person, you can use the yields that they have had in their history. If you participated in the management physical activities, but you didn't actually have a share. So think in terms of a son or a daughter that has worked with dad and mom through the years. They didn't actually have a share in the crop, but they were out there planting the crop and talking through the activities and things. And now mom and dad are going to turn that operation over, kind of thing. And then for perennial crops, your vine and tree crops, mostly vine and tree crops, you can use a previous owner's yield. So if you buy a grove, you can use that previous owner's yields when you get ready to set up your policy. If you don't have either your own actual or another person's yields, there will be things called county transitional yields. We call them T yields because it's a whole lot easier to say than transitional yields. Basically, they're designed to reflect an average yield for the crop in the county. And as a beginning farmer, or as a beginner, you can qualify up to 65 or up from 65% to 100% of the T yield for your missing yields. It kind of depends. There are several different things that determine whether it's 65% or 80% or 100. And we can get into that a little bit further if you have questions on that. There are also some yield enhancing options that you can purchase for your policy. Basically, they're designed to increase your approved yield, and they're not available for all crops. We're going to kind of go on these on a kind of a high level. The yield floor basically says the county T yield is, let's say, 100 bushel for this county, for this crop. It's 100. The county T yield is 100 bushel. It won't let you drop below a specific percent of that. Your approved yield will never get lower than that, let's say 60% of the county T yield. It won't ever let you drop below. And this is built into your policy. You don't have to select it. It's actually just built into the policy. The trend adjusted yield. So if you think in terms of, say, just for the easiest example, when you look at field corn, through the years, they have developed new genetics, and the average yield has just been increasing every year exponentially. Well, I've got 10-year-old yields in my history, and they weren't the same genetics as they are now. So they developed a trend-adjusted APH program for some of the major crops that basically gives you a boost to reflect those improvements in genetics. And again, that one's not available for all crops. Yield substitution is pretty much available for all crops. And what it does is it says, let's say you had a year in your database your yield was very, very low. And the reason it was very, very low is because you had a really severe drought during that year. What it will allow you to do is say that what was a T yield during that year, and you'll get 60% of that T yield, and it will replace your existing yield. So that kind of gives you a bump up. There's also yield cup, which said if my approved yield was 100 bushels last year, and I had a really bad year this year and it dropped my approved yield to 80 bushel, it won't let that approved yield drop below 90. It cups it out at no more than a 10% downswing from one year to the next. And finally, yield exclusion. Basically, it says if the county that you're in experienced a huge loss countywide, then what we'll let you do is throw out that year from your APH, from your history. So you won't use it in the calculation of your approved yield, because your approved yield, and I didn't mention this earlier, it's basically a simple average of your yields from previous years. So if you had 5 years of yields, it's going to add all those together and divide by 5. It's just a simple average. Well, if one of those was a 0 because you had a wipeout because a hurricane came through and the county qualified for yield exclusion, you won't use that. You'll add all your yields together except for that year and divide by 4. It's as if it didn't happen. So those are some of the options that you can buy. And this next slide just kind of goes through some examples of what that looks like. So let's say your actual yields, you had actual yields from 2019 to 2023. You have 5 years of actual yields. And that gives you a 4.1. We're going to use this one as a ton. It gives you a 4.1 ton average. The T yields for each of those yields, remember that's kind of reflecting what the county average is 3.6. Okay. So if you had elected the yield adjustment, if we look in 2023, you had a 1.3 average yield, but the county average or county T yield was 3.6. So we'll take 3.6 times 60%, and your yield is below that. So it's going to plug in, if you qualify for VFR or a BFR, you'll get 80% of the county T yield plugged in place of that 1.3. So in this case, you got 2.2 as a yield for 2023 instead of 1.3. That's using the 60%. For a VFR or a BFR, it'll be 80%, which would be, I think, 4.0. I'm not trying to do math really quick in my head and it never works out. But anyhow, it'd be 80% instead of 60%. The next option, the yield exclusion. So in that year where your county triggers as a yield exclusion in 2023. So basically there was a huge loss countywide in 2023. So what it does is when you're figuring your average, you don't include 2023. So you add up 2019 through 2022 yields and divide by 4, and that gives you a 4.8 approved yield, which is your best bet yet. And then finally, the yield cup, it says, okay, when I add in that 1.3, it dropped my yield below 90%, which 90% of my average from the previous year, which would have been 2019 through 2022, it won't let it drop below 90% of that. So it cups it out at 4.3. So these are the options you have. And if you had elected all of these options, it would look to see which one gave you the best approved yield, and that's the one you receive. So if you'd elected YA, YE, and YC on your policy, you would have received a 4.8 approved yield for this year. And it doesn't charge you for the YA or the YC. It only charges you on farms in which it triggers. Okay, so if you're in a year where the yield exclusion, the yield cup, and the yield adjustment doesn't trigger on any of your land, it doesn't cost you anything. The buy up or the increase in rate only happens when it bumps your yield up. So a lot of guys will just elect all of these because it doesn't cost them anything, but then in the year when they really need it, it'll kick in. All right, so we're going to talk about what happens when we have a cause of loss during the insurance period. So we know what our guarantee is. It's our approved yield times whatever coverage level we elected. What we have to figure out is what did we end up with? So that's called our production to count. So a production account, if you have a loss, you'll turn in a notice of loss. The loss adjuster will go out and determine your production to count, which is how much crop did you harvest, or how much crop is still left in the field or grove or orchard that you're not going to harvest because it's damaged or it's, I mean, there's just not enough there to make it worth harvesting. All right. If the production to count is less than your guarantee due to insurable causes, then you have an indemnity due. So the first thing you do, as I mentioned, is you file a notice of loss with your agent. The adjuster comes out, they work with you to determine what your production to count is, and then the company is going to issue an indemnity payment. AIP stands for Approved Insurance Provider, and that's what the companies in federal crop insurance are referred to as is your AIPs. So we're going to go through a couple examples here just to give you an idea how, just a top level idea how the policy works. In Edgefield County, South Carolina, a producer has 10 acres of peaches and they elect to insure them under the APH program. Their approved yield is 200 bushels per acre. So let's say they had 10 years of history, and when you do the simple average of all of their historical yields, it comes up to 200 bushels per acre. They elected 75% coverage level and 100% of the RMA price. So the RMA price is $29.40, and they said, if I have a loss, I want to get paid $29.40 a bushel. If they wanted to cheapen up their premium a little bit, they could have said, I want to get paid 80% of that price, and that would have reduced their premium by about 20%. They also have a 100% share in the crop, which means they are not crop sharing with anybody. All the crop they sell will be all 100% their revenue. All right, so my approved yield is 200 bushel. I've got a 75% coverage level on 10 acres. My yield guarantee, what I'm insuring is 1,500 bushel. Okay, if I grow less than 1,500 bushel, I will be due an indemnity, provided it's because of an insurable cause of loss. Now we're going to put a value on that. So we take that 1,500 bushel per acre and we take it, or I'm sorry, 1,500 bushel total, and we take it times the RMA established price of $29.40. And I elected to insure it at 100% of the price. So the value of that production to guarantee is $44,100. Due to wind and excess rainfall, I had damage. I turned in a notice of loss, and I only harvested 900 bushel total on those 10 acres, 90 bushel an acre. So my harvested production, we're going to put a value on it. We take that 900 bushel times $29.40. And again, I insured 100% of the price. So the value of my production to count, my 900 bushel production to count, is $26,460. To determine my indemnity, basically I'm taking the value of my guarantee minus, got a wrong sign in there, not times, but minus, excuse me, I'll fix that for the final version, minus the value of production to count times my share of the crop to get my indemnity, which in this case would be $17,640. Another way to look at this, we had a 1,700 bushel guarantee. We only harvested 900 bushel. So for those missing 800 bushel, they're going to get paid at $29.40. So pretty much when you're talking in the field, that's how you discuss it. But this is the actual nuts and bolts of how the policy works together. So when we're looking at this, the value, my total value of the crop, my total 1,700, oh, in this one, we have 2,000 bushel times that 29.40. So we've got 2,000 is what we expect. Historically, we have 2,000 bushel that we expect to insure, but we have a deductible, and that's basically your 2,000 bushel that you choose to insure times 25%. That is the amount that is not covered under the policy. The amount that, well, we've got a slight difficulty, I do apologize, in our thing. The amount that is covered under the loss is 600 bushel. So we've lost 1,100 bushel. So we have 600 bushel that are covered and 900 bushel that you actually harvested. So those 600 bushel are going to be covered under the policy because you had a 1,500 bushel guarantee, but you only harvested 1,100 bushel. The first 500 bushel are on the producer, and the next $600 the AIP will cover, and then the last 900 bushel you actually did harvest. I apologize for the graphics there because not sure what happened there, but they just disappeared. When we talk about catastrophic coverage, basically catastrophic is the lowest coverage level that you can buy. And why, the reason for that is the maximum coverage level you can buy is 50%. And the price is at 55, only 55% of the price. So as you can see, it's the very, very low coverage. The thing about catastrophic coverage is the government provides 100% subsidy on the premium. So the only thing that a grower pays on a catastrophic policy is the administrative fee. Remember, if you qualify as a veteran farmer and rancher or a beginning farmer and rancher, you don't pay administrative fees. So there's actually at no cost for a catastrophic policy. So we're going to kind of walk through. Approved yield is 200 bushel again, 50% coverage level on 10 acres. The yield guarantee is 1,000 bushels. Again, you can see a lot lower coverage level because you're only insuring at 50% instead of 75%. And then that value of production to guarantee is also a lot lower because instead of insuring at $29.40, you're only insuring at 50% of that $29.40. So we have the same event, wind and excess rainfall. It damaged the crop and only 900 bushel were harvested. So we're going to take that 900 bushel times $29.40 times the 55% of the price to get the value of production to count, which we'll just subtract from the value of the production guarantee. And you can see here, same scenario, but 75% coverage level versus the CAT policy. The CAT policy only indemnifies at $1,600. So a lot less coverage, but a lot less cost. So when you're picking your coverage levels, you need to get with a good agent. And we've got some tools out there to help you to find a good agent. The RMA website has a lot of good tools out there to help you find a good agent. But when you're talking with your agent, it's, you need to look at your operation, what you can afford to lose, what would take you out, and make sure that you have enough insurance to cover you for that. So that concludes the module for this series. And if we have any questions, now would be a good time.
So far, no questions, Kim.
Okay. All right. Well, again, we will put this presentation out for you to review again. I'll fix the graphics on that one slide, and we'll put a presentation out there for you guys if you want to go back and listen to it again. And there's also a PDF version if you want to study it. If you have any questions, please feel free to reach out to Diego, and he will make sure that the questions get to us so that we can answer those.
Yes, and thank you for that, Kim. And again, this is being recorded, so this will be uploaded to our YouTube channel, so you can view it at your own time. Be on the lookout for our next webinar on April 9th. We'll be going over grapevine and tree programs. It'll be on Zoom again. It'll be joined to everyone else here. And see if I got anything else. I believe that's all. Let me put the link to our YouTube channel just in case you don't have it. So be on the lookout for the recording of this. It'll be uploaded within the end of the week. And just be on the lookout for our next webinar. Anything else, Kim?
Don't have anything else. Thanks, Diego.
All right. Thank you, everyone, for joining. You have a great day.
Bye.